Hey traders, Raghee here, and in this free video we're going to cover Crude. Now Crude's done something that I've been waiting for a little bit, and that is it has started printing consistently above the 13 and 21 exponential moving averages. Again, more specifically, it's begun printing above my 13 propulsion dots and 21 propulsion dots. And this is a free tool that I make available to members that takes advantage of an 8-13 cross EMA and an 8-21 cross, again, exponential. And then once that interacts with price in a very specific way, it's not just the moving average cross. They interact with price in a specific way. The propulsion dots start plotting, and they plot where the 13 and the 21 EMAs would be. But think of it as a self-correcting exponential moving average. Again, it's a free tool for members, and so this is one of those things that I think has made a big difference in clarifying the kind of signaling that exponential moving averages can so powerfully give us. So it's turned back on again. That is part of my sort of formulaic approach to identifying what a trend is. This isn't quite as mature a trend as I'd like, but it is starting to become something that we can open the door up to potential pullback buys. So let's talk about this for a moment, because I do want to start thinking about pullback buys, and specifically in this range. Now this range, I'm kind of showing you in dollar denominated fashion, it's about a $1,700 range from the first opportunity to get long to the validity of the trade. And so I would say at the first two layers of the entry, the 13 and 21, even the 34 EMA on the high, which is that solid green line right here, I would focus on crude oil or USO calls. We'll talk more about what strike and expiration in the premium video, but I would focus on calls in essentially even this section, all the way down to the 200 EMA. And then that would leave trading the underlying futures contract, the CL, down in this area. Notice how we've essentially, by more than half, cut our risk. So from the 13 to the 200 EMA, you focus on the call options. From the 200 to the 34 period exponential moving average on the low, which is what this red line is, I can focus on crude oil, cut my risk in half, and still have an approach to get long. So this is how I sort of split trades between different instruments. Crude oil options, even USO, and then the underlying crude oil futures. Now remember, there is a QM mini contract, so that's something that some of you might be interested in as opposed to the CL. I would definitely keep an eye on that. We'll definitely talk a lot more about this in crude oil stocks like ConocoPhillips that I'm looking to see go along higher for the ride. We've gotten through the OPEC meeting, and the markets are feeling pretty good about OPEC having a grip on these production cuts, and even opening the door to OPEC Plus also going along with more production cuts. So that and inflation trajectories have me looking at higher crude and generally higher commodities prices in general. Speaking of commodities, we'll talk about this phase one trade deal, how soybeans are reacting, if at all, and really what does that $40 to $50 billion for the next 2 years mean? Here's a hint, not a whole heck of a lot, gang. I'll see you in the next update.